Okay, welcome everybody to our latest webinar, Capital Raising Through Market Volatility. Now, I guess between the volatility of the market since January, inflation rising, the war in Ukraine, and the fact that the news seems to be filled with doom and gloom these days, we are getting constant questions from issuers and partners wondering what does this all mean for their raise. We're in a unique position given how many raises we work on and how much data that we have on those raises. So today we're going to share some of that data and give a breakdown on what we are seeing in the markets and where we see everything headed. So thank you for joining, and we'll get started. All right, as we switch the slides, I'll start with the introductions. So first up, we have the one and only Rebecca Kacaba. Rebecca is the Chief Executive Officer and co-founder of DealMaker. She practiced law on Bay Street for over 10 years, founded the startup practice group at one law firm, and was co-chair of the Toronto Venture Technology and Emerging Growth Companies group at another. Rebecca's vision and drive have landed her in Lexpert's top 40 under 40 and recognized as one of North America's most innovative lawyers by the Financial Times. In her career that has spanned both the 2008 financial crisis and COVID, Rebecca has seen countless raises on DealMaker, in addition to advising numerous issuers during her legal career, and has also raised capital herself successfully several times for DealMaker. Next up, Jonathan Stid. John is the president of DealMaker Reach, which is the leading digital marketing agency for equity crowdfunding, helping their clients raise a collective $400 million over the course of the last 18 months and across 50 different campaigns. He serves, his role as president of DealMaker Reach has started since he joined DealMaker after Ridge Growth was acquired by DealMaker a few months back. John's background is in management consulting, or has a background in management consulting, and has founded multiple companies, building initial teams, go-to-market strategies, as well as shaping brand and marketing strategy. As one of the leaders in the crowdfunding space, there is really no one in a better place to discuss investor behavior and trends, especially as we're seeing them now. Finally, I'm Mike Wary, the VP of Sales for DealMaker. Work with numerous partners, issuers, and enterprises in my role, and have a pretty deep perspective on what's happening in the overall market. I have a background in growing sales, a number of different organizations in finance, real estate, banking, and sales. A quick disclaimer here. And so today we're going to cover 4 key topics: market analysis going back to 2000, looking at trends for the issuance of private securities, both debt and equity, and how they've performed during periods of volatility and downturn. Second, an overview of what we're seeing with the VC and other institutional private equity and how this impacts crowdfunding and capital raising as a whole, and how businesses are thinking about capital raising with that happening. Third up, our data. We're going to get into looking at some of our data over the past couple of years, and particularly over the past few months, to show the impact on raising and investor behavior. And then going into the overall market sentiment, how this will impact capital raising going forward, and trying to provide as much of a crystal ball as possible. And finally, we will leave time for questions and answers. But as always, please feel free to use the Q&A functionality in the webinar here. We can always jump into them as we go through. So first up, I think the synopsis is, we've seen this before. 2001, 2008, 2020, periods of public market downturn and economic instability have led to a pause and recalibration. This often lasts a couple of months, but it's really issuers are trying to think about what this means for them. Right now, the big question is on valuation. We'll get into that a little later on, but looking at this chart, it shows both debt and equity. Debt is in white and equity is in green. By year since the year 2000. In 2008, we actually saw an overall growth between 2008 and 2009 of 19%, but equity issuances grew by 23% in 2008 versus 2007, and then again by 28% in 2009, showing really a strong resiliency in in the private markets and private market securities. In 2020, equity issuances were up 77%, and last year, although I don't have full data on it yet, last year was gangbusters, as we all know. And I think the other thing to note is we haven't seen an overall decline in equity issuances of more than 20% since the year 2001. And while this year there may be a bit of a decrease year over year versus last, it's also from such elevated levels that we feel that the impact will be not terribly significant. So before I turn it over to Rebecca to share some of her experience in 2008 and John as well, I guess the synopsis is like good deals are still getting funded and will continue to get funded.
Yeah, thanks, Mike. I think for any of us that were around the capital markets in 2008, when you're running in such full tilt, and we'll look at a bit of the comparative of how the markets have been acting in the last year or so. When there's such a frothy market, sometimes when there's a bit of a slowdown, it feels like you're running into a brick wall. But when you step back and you look at the numbers, and I remember in 2008, that feeling of the case when there was so many deals and you were working all-nighters, if you look back, you see the growth actually was there and the deal flow was there. It's just the comparative market reaction that makes it really feel like such a big change.
Yeah, and I'll just add for the 2020 year there with COVID from a digital perspective, right, where during COVID, the digital trends, both for just digital in general and direct-to-consumer commerce, right, that also extended itself to investing online, where those habits became normalized. And then, in light of the recent market downturn, we've seen that those trends are now more persistent behaviors. And as Mike said before, good deals are good deals. So we're still seeing a lot of activity in the investor acquisition space and overall investment volume from these. And we'll get into some of that data in the following slides.
So venture funding is projected to hit a 19% decrease in the second quarter of this year as compared to the same quarter last year. Deal activity is projected to have a 22% drop, being the lowest activity we've seen in the last 7 quarters. So VC's not writing checks now. Lots of people speculating as to why. I have my opinions. If you look at some of the funding activity that was taking place last year, you had some VCs coming into the market like Tiger Global, writing bigger checks, pumping up valuations with their investment strategy, and then others having to follow suit in order to compete and get access to the best deals. And those strategies work as long as the market keeps going up. That strategy can work to provide returns. But when it looks like that was done at the peak of the market, you start to see those portfolios having significant devaluation. And when it comes time to raise again for those companies, now we're seeing Andreessen and Horowitz publishing articles about how to get funded on a down round, what strategies to use to raise when your valuation is underwater, how to extend cash and make it count. And so that kind of flux environment is leading to a little bit of a pause in the VC funding market going down. When the public markets go down, that is tied to the VC market, right? Because if you're trying to call from your LPs and they're not going to write a check, that's likely because they have a vast public company portfolio and they're getting margin called on that portfolio right now. So what are you going to do? You can't force them to write a check, even if they promised it. You're not going to sue your investors, but you've got a little bit of a tightly wound circle here where capital calls are being made and not being funded. People are getting margin called. And so those sources of capital are really tightening. If you want to go to the next slide, we're seeing major declines being projected across a variety of categories in terms of economic activity, mega round seeing a 10% drop, and the IPO market slowing. So what does that mean? When there's excess capital, it needs to find a home in a place, right? And we saw that last year with the SPAC market starting to boom, crypto markets starting to boom, a lot of cash being out there, and these alternative markets taking shape. But now we're in the opposite sense where you see traditional sources being less prevalent, and then you're going to see alternative sources of capital flow in to balloon out and fill that void that is being created. So you see global corps developing in-house investment firms. And then along comes this retail capital raising space where we're looking at the numbers that we're hearing from John, and we're saying, hey guys, this sector is okay. You got Mike and Rebecca and John sitting here and saying our sector is fine because our sector taps an entirely different source of capital from a different investor base that isn't getting margin called on massive public company portfolios. And they're not massive crypto investors whose portfolios are down. And so the space is behaving differently because the investor base is different and it has different trigger points. And so that's a really important consideration as this space it matures and grows and develops. And we're going to see balloon in to fill some of the void that's being created by other areas.
Yeah, thank you so much, Rebecca. That was awesome. But I think, just to add on to that, I talked about in the prior, one of the prior slides about the recalibration and like issuers are thinking about valuation. And that's really what we're seeing right now, coming into the height of everything sort of towards the end of 2020 or 2021, we saw some crazy valuations happening. I mean, not in the venture capital world, which is a big impact. It has a big impact on why people are so hesitant to deploy capital and dry powder that's there. But also in the equity crowdfunding world, you had, startups with pre-revenue idea stage, coming out with valuations of like 350 million. And, that won't fly. Equity crowdfunding is still much more supportive of a higher valuation. But I think it just means that, if there's one sort of piece to take away here, it means that people need to think a bit more about their valuation and have something that's a bit more reasonable. And because we're seeing that, that's one of the reasons for the big public market downturn. Valuations just got a little crazy, or a lot crazy in some cases. And so here, we talked about, Rebecca sort of made a good point about the, as VC funding sort of starts to get especially harder and harder, but dry up more and more, what is the impact on filing data? And really, we've looked at this, although we don't have the full quarter for Q2 2022, the numbers to date are very robust, year over year, and there has been some cyclical trends in Reg A filings year over year, with the earlier part of the year being a bit slower and the latter part of the year being higher. But year over year, we were up in Q1, and we are pacing to be up in Q2. And just on top of that, like the filing pace isn't slowing, but the other knock-on effect of VC funding is that we are seeing now more interest, especially earlier stage, like pre-filing, from companies, and some companies that are even much bigger than what you would normally expect to see in the equity crowdfunding space, particularly Reg A, like some big well-known companies who are looking at this as a means of funding. And I see a lot of value in that. Like the growth in the space will bring in more investors to the space and will drive just greater awareness of it overall and more investor activity.
And to that point, this chart here shows issuers on DealMaker and the influx of capital, right? So as we look at this, the amount of capital flowing through the system is still robust, right? And to Mike's point before, sure, some companies in the public markets have gotten kneecapped, but the Rivians of the world with zero revenue, right, didn't really deserve some of those valuations, right? So, anecdotally, right, we've had 2 separate campaigns in the last 2 weeks have $1 million days individually, right? So still a strong appetite for investment, for good deals, really in the teeth of this downturn, right? So to be able to do that in the past 2 weeks with all of the market turmoil is pretty impressive. And in thinking about that, the reasons for that are twofold, right? So there's economics, and then there are emotions. So for the economic perspective, right, our investor demographic is 35 to 55, right? And that group is going to be, in that investor group, also more affluent, right? So for something like inflation, that's going to eat up less of their discretionary income. So in that sense, they still have disposable income to invest in startups, right? Or invest in these private placements. And that leads into the emotional aspect where, there's a high emotional aspect to investing in these companies, whether that's, a company that they're just excited to have ownership in, right? To be an early investor in, right? Or companies that they're passionate about, whether it's an industry they feel strongly about, AI and robotics, right? Or an ESG company, right? So there's a lot of emotions at play here. So I would say the economics and emotional aspects of this really help propel the sort of continued influx of capital that you can see here on this chart.
Yeah, I think that's such an important point, John, and I just want to pause on it for a second because I think a lot of people who aren't intimately involved in our space don't appreciate how much that emotional connection to the campaigns drives the investor behavior. So just want to reiterate that.
Yeah, it's a massive component to it. And those are things that we're able to highlight in the ads, visually and viscerally. And that's part of what we do creatively, right? And, have a lot of webinars around those to really drive that. And the sort of commentary that you see in ads oftentimes is really around those emotional aspects where people aren't asking fundamental questions. It's more around excitement in the industry at large as opposed to some sort of fundamental question, about the valuation of the share price, right?
Yeah, and it comes back to what I said about this asset category behaving differently. That's very different than the way people traditionally think about the equity markets, because it's very different than the way the institutional, well, arguably, I guess, maybe Wall Street is a little emotional, but it is a very different segment class in the way it behaves.
Certainly. And we can get into some of the numbers here. So I'm referring to these issuers as community rounds, right? So despite the larger market sell-off, if we look at KPIs that we track, something like return on ad spend, right? So what do you get when you invest a dollar into marketing spend? We've seen that deteriorate by about 15%, right? So, we've had campaigns range from, 5x to 20x return on ad spend. But for a concrete example there, right, we're looking at, 500% return on ad spend now deteriorating to, 425%. So, companies are still able to run these raises in an economical way for their community round, right? So not just on a cash basis, but if we look at the supporting reasons why issuers are excited to run these campaigns, right? Mike alluded to this earlier, valuations, they're typically more favorable, right? And to Rebecca's point, the sort of emotional aspects that drive these behaviors in investing, people are excited to invest in these companies. So, plus or minus a couple percent of the valuation, right, isn't going to move the needle as much. So, valuations for these companies are typically more favorable. There's the ownership aspect where typically maintaining more control, but also the brand building aspect, which is the key driver for issuers who really seem to get this style as a means of raising capital, where it's brand awareness. And when you have that brand awareness, for a campaign that closed in May, we served over 200 million unique impressions throughout the lifetime of their campaign, right? So customer acquisition was a byproduct of that campaign. And whether that's a direct-to-consumer company or B2B, we've seen them all have direct-to-consumer acquisition as a byproduct of it. And then those investors are also brand evangelists, right? Again, talking about the emotional aspects of, maybe it's an industry they're excited about, robotics, right? Or maybe it's something in the carbon and clean energy space. These people are, once they own shares in these companies, incredible and brand evangelists, right? Because this is a unique investment opportunity for them to have access to. So despite what we've seen in the market downturn, our actual KPIs have remained resilient. And then there are the additional benefits of raising capital through this means that continue to bring issuers to the platform, which is supporting the number of filings that Mike spoke through earlier.
Yeah, and I think just to sort of touch on that and sort of reiterate on some points that you both made, like I do get this question, and I've gotten this question a ton over the course of the last few months, is, with the NASDAQ and everything down, 30%, crypto or Bitcoin in particular imploding just over this past weekend and down, 30 or 50% or something like that over the last month. Is this really and inflation too? Is this really impacting the investor? And to the short answer, you can see it a little bit, I guess, with there's a slightly increased cost just to sort of build that funnel, but it's still very economical. But more so from the demographics, like it is 35 to 55. It's not crypto bros and like the Wall Street Bets group who are, who got hammered on GameStop or whatever the latest fad, and were, playing around with, $5,000-$10,000. These are more affluent professionals, and so it's the impacts to them aren't as significant. There's still lots of investment happening, and as John reiterated, we're seeing great deals, still being able to raise massive amounts in single days. $1 million plus days and $1 million days, day over day for a couple weeks on end. So I think that we obviously talk a lot about Reg A and CF and the equity crowdfunding space. Obviously we do 506B and 506C as well. But I think the things that we're going to see right now is a big downturn in venture capital or deployment of venture capital and other private equity institutional. The other thing that we are seeing is, there probably aren't going to be any substantial IPOs until, especially in the tech world, probably until next year. And what that means is really, it is most likely or is looking at a big boom in people looking towards Reg A and CF as alternative sources of capital, and it solves a number of different issuers. It's more favorable to higher valuations. Again, like we don't want to get crazy with the valuation, but it is more favorable with valuation. It allows you to cover off a number of different areas with engaging a customer base, engaging your customers and turning them into shareholders, and engaging people who are aware of the brand as well as building awareness of the brand. And so we see a huge growth over the course of the next year in this space, and are very excited about that. Any questions that you have, just given that I've been having it or talking to issuers every single day for the last 6 months, I know there's lots of them out there, so feel free to ask. But yeah, just anecdotally, we have had, in the last 2 weeks, we've had one issuer raising $1 million pretty much day over day for the last 2 weeks. We saw another one launch this past week and raise $1 million in a day, literally on the same day that all the public markets were down, but it was the NASDAQ was down like 5%, like it was on that same day, and still continued funding for great deals.
Yeah, I think that's the key, Mike. Good deals will get funded, and this asset class knows good deals, and they're ready to invest in them. So people can have confidence in that based on the numbers we're showing.
John, there's a question for you. How much did they spend on paid ads to drive 1 million? I know you're on one campaign, but if you want to sort of add in on that and sort of discuss the ins and outs of ROAS and spend.
Yeah, certainly. So the campaign that I was referring to spent just under $200K that day for that 1 million in investment dollars, right? The way that we, another KPI besides funded investments that we track, right, is going to be the top of funnel dollars there. So people who have indicated a dollar amount that they would like to invest and just haven't yet invested it. So, well, the 1 million was sort of, bottom line from that. There was an additional 2 million in top of funnel that day as well. So, and obviously that will trickle in as we do things like send out SMS and emails and, invite them to the webinar that's later this week. So we'll continue to see that, functional return on ad spend from the initial 200K increase.
Another question, would you mind pointing out a couple of key differences between a CF and a Reg D? Yeah, so think about Reg D as accredited investor. You've got 506B for accredited investors in your network, and then 506C for accredited investors that you may not have a pre-existing relationship with. So Reg D, very quick to get up off the ground. You can spin up a portal on DealMaker with a subdoc that your lawyers reviewed, and you could go out and start raising, but you can only go out to people that have a high net worth or financial knowledge. Whereas with Reg CF or Reg A, Reg CF being capped at 5 million, Reg A going all the way up to 75 million, you can use a lot of the tactics that John is describing because you can accept investments from both accrediteds and non-accrediteds. That means that you're going to have to put together a disclosure document. For Reg CF, it's much smaller. You're going to need audited financial statements so that the SEC feels that those investors are protected with having that baseline available information about the company. So Reg D, quick to get off the ground, but accrediteds only. Reg CF and Reg A, you can digitally market and reach out to the wider pool across the USA.
Awesome. And then John, I don't know exactly what the question is, but you sort of touched on it a little bit, John, on pre-revenue CF and sort of like what we're seeing. I mean, obviously CF is usually for earlier stage companies, and obviously capped at 5 million versus Reg A at 75. So generally for people who are looking for less capital. But what you're seeing in terms of investor behavior and spend with pre-revenue companies in CF?
Yeah, pre-revenue will depend on the sector as well as the problem solution, right? And by sector, sort of a euphemism for, how visceral can we make the ads, right? Robotics, that sort of thing, where it's very, very visual gaming, right? You can get around some of the pre-revenue aspects by, people that they're very excited in the physical product that they see. And then additionally to the sector point, they see a large market opportunity on top of that, right? Where if you are pre-revenue, you can overcome it by being, in a very exciting space with a lot of potential upside, with something that is concrete despite not having sales behind that, right? Letters of intent, work to some extent. And then additionally, I would just say, a problem and solution that's easy to grasp. If you're, pre-revenue and also have a convoluted problem solution that takes a lot of education to understand. It's not impossible, but it takes more of those, email follow-ups and webinars for us to be able to digitally communicate the problem solution to the potential investor and drive them over those investment hurdles, as we call them. So certainly some hurdles for pre-revenue companies there, but that's across any market where we see that for investment activity. But yeah, that's what I would say too for pre-revenue companies. But feel free to throw more questions in the chat there to follow up.
Yeah, and there's actually as a follow-up here in terms of the total market data for CF companies. I don't actually have that offhand that I can share right now, but I can summarize it. It might be good for a blog post as well for DealMaker. But Nat, I can also send that. I can send that to you afterwards.
Another one came in, John. I don't know that you can say it definitively, but what is the requisite ad spend to raise 5 million in a Reg CF using the DealMaker platform?
Oh, sure. Thank you, Mike. Yeah, again, gonna depend on the company, right? Where we've seen, anywhere from 4x return on ad spend to 20x return on ad spend. So it's gonna depend on the underlying, pillars of that investment opportunity: traction, market size, team, right? That sort of thing. But typically, it can be anywhere around 10 to 15% of that total raise, right? the sort of key there is how do you distribute that market spend over the raise, which is something that we've compiled from running 50 of these. So I'm happy to speak more to anybody about that. But in terms of the channels, right, that have proven most effective, again, very company specific, and that's part of the benefit of the DealMaker data, right, where we're able to see spend by day, by channel, and the results of that, right, and down to the keyword that we can track with how we set up the sort of nomenclature for the tracking infrastructure. It's a longer discussion about app tracking transparency and sort of last click data being cut off, but DealMaker has some workarounds around that where we do get last click data. So it depends on the company, but that's something that we allocate on a daily basis based on what we're seeing from the data. So it really depends on the company for what those most effective channels are, but it's often a healthy mix of what we're doing across Google and the whole Google umbrella, Bing, right, paid media, and the partnerships that we have exclusive access to, which are email newsletters and sponsored content.
So here's a question: do we have any case studies of Reg CF and or Reg A for deals that use metaverse technology such as digital twins, augmented reality, and 3D for commercial building property, or related to CRE? So I would say just overall, I mean, we have done deals in the metaverse space, and that has been obviously a very hot topic over the course of the last 6 to 9 months, maybe even a bit longer. Like we've seen those do quite well. I do know of a deal that does 3D printing for homes that, and I'm not exactly sure how that's performing, but I have seen those deals. Like I think that, John, I'll let you jump in here in a second, but what we see in terms of things that perform, good deals overall will perform, but from a Reg A and CF perspective, things that are in the zeitgeist and are really hot right now do perform. We saw that in late 2020 and 2021 with electric vehicle technology. We've seen that recently with things like carbon. We saw cannabis and psychedelics do really well. All those deals that are sort of really big in the public mind right now at that point in time, of which metaverse is very much so of that.
Yeah, I would just generally agree with that, where a lot of those topics in that question were certainly all on the zeitgeist, right? When we think about digital twins and metaverse and AR, right? Some of the hurdles there would just be the educational components and making sure, investors understand the value of that when applied to commercial real estate.
Oh, we've definitely got through a bunch of questions. I don't know if I'll leave it open for another minute or so if anybody has anything additional. Okay. Understanding the capital raise max of a CF. Would you mind sharing an example where a Reg D would be a better choice than a Reg CF?
Well, Mike, let me take a stab at it and then you can jump in. I think we have seen a lot of issuers do a Reg D prior to a Reg A, right? Where they have access to some accrediteds or network who will write a check to get a company seeded. You can get a Reg D off the mark with the cheapest cost of any of Reg A, Reg CF, or Reg D. So you can use that exemption to get the company seeded with some capital and then use that capital to move on to a bigger marketed raise like a Reg A or a Reg CF. A Reg A can be not all that much work to get off the ground if you're going to do the audited statements anyway, if you've got your business plan written up and you're going to invest in a marketed raise, it then will become a choice of the issuer whether they want to do a CF because they're only going to go up to 5, or they want to leave themselves room to go up to 10 or 15, do the A, and just raise enough capital for a longer period of time for the company's life cycle. So that'll come down to decisions about valuation and the amount of capital you want to raise. But definitely, if you're not going to digitally market the raise and you've got access to some checks, then definitely throw up a Reg D, get that off the mark, and get the company capitalized.
Yeah. And just to add on that, I mean, and I will just point back to the original disclaimer. I'm personally not a lawyer, so this is not legal advice by any means, but you can also do them concurrently, right? You can do, we have seen lots of issuers run a Reg A and a Reg D, or a Reg CF and a Reg D concurrently. You can do that, so it's not necessarily an either or. It's a question of, what are the goals? Like a Reg D, especially a 506C, which allows for general solicitation, is not, it is hard to market to accredited investors. Like it's generally harder because, as opposed to any people raise that includes retail, it's a sniper approach as opposed to a shotgun blast, where you can capture basically anybody 18 plus. So it's a little bit harder, but yeah, it's not necessarily an either or. It's really understanding what the goals are as a business, what your network looks like, and what you're really trying to achieve, and that can be determined both in sequential raises or raises at the same time.
Question, do we find we have to do a lot of educating about Reg A as a funding option, and has that changed in the recent environment? Anecdotally, I would say we are getting many more inquiries. Reg A has been around for long enough now, and with the recent environment, we are getting calls from folks who are saying, I've heard about this Reg A thing, now it's time for me to really consider it. Let's talk more granularly about what my options are. And I would say over time, the space has grown and grown, so that there are lots of players in the market, us being one of the originals, who are very well educated about the space and have been doing Reg A for some time. So Mike, your sales team probably fields the most of this. Maybe you have a different opinion, but I would say the education required is getting less and less as market awareness about crowdfunding and retail capital raising grows.
Yeah, for sure. I would say that there's always an education process, even for, people who we're talking to, who I would consider like the true believers in Reg A. They come to us, they know they're doing a Reg A or a CF, and they absolutely understand it and believe in it. It's a newer space. It's growing and evolving rapidly. And so there's a lot of education in it. I would say the big change over the course of the last year is just around overall awareness of Reg A or CF as a funding option, and the benefits of it and what it can mean. And that's even, I see that pace increasing now as we've talked about venture capital drying up. The IPO landscape isn't terribly hot, or it's definitely not hot at all. People are really looking towards this as a viable option. And, although I won't share names, there are conversations that we are having and entertaining that are with way bigger and more known companies than you would have really seen in the space even 6 to 9 months ago. So the landscape is changing dramatically, and the awareness of it. And like similar to what the Green Bay Packers raise sort of like showed, and that raised a lot of awareness. It wasn't a Reg A, but it behaved as Reg A as you possibly can. Hundreds of thousands of shareholders coming together to purchase securities at $300 a pop, and doing so because they're believers and fans of the Green Bay Packers. And that really showed the power of this kind of raise to the broader market, and that awareness continues to grow. It's an easy question. Well, sorry, pardon?
More companies realizing, right, that they have an asset in their mailing list and in their following that they can monetize.
Mm-hmm. This is an easy question here. Can DealMaker do Reg Ds? Yes, we can. We can do basically any type of capital raise that you want. Debt, equity, Reg D, Reg A, Reg CF, international deals, Canadian deals. We do them all.
All right, great. Well, thanks everyone for joining. Great engagement from the audience. So Thank you for that.
Yeah, thanks everybody.
I hope you enjoyed it. We will send around both a copy of, or a recording of the webinar. We will send around a copy of the deck. And if you have any questions, want to talk more, Jeff, Dante, Nat, anybody else, we're happy to chat. I'm Mike at dealmaker.tech, pretty simple. So feel free to reach out.
Perfect. Thanks, everyone.
Thanks,
Thank
everybody.
you.